The topic for us is how to make prosperity inclusive. But have we in India locked in an enduring cycle of prosperity? We need to face that question front and square, because the answer to that question will also ensure or determine the success of the outcome on inclusion. Frankly, the answer to that question from my perspective, have we locked in a cycle of enduring prosperity? The answer is no. Pre-2008, India's economic growth was a function of lot of one-off serendipitous factors. And we assumed that we had arrived as a fast-growing nation. The 2008 crisis put paid to those claims that we had arrived as a fast-growing nation. Post-2008, we resumed growth, but as a consequence of extremely reckless government spending policies and also monetary policy. That is why in 2013, we had a collapse of the Indian rupee, a rising current account deficit, and 5 years of double-digit inflation in the country up to 2014. Now, 2014 to 2016, we witnessed a collapse in global crude oil prices, and therefore the economy rebounded, and there were some very important deregulation initiatives by the new government, including financial inclusion, the Prime Minister's Jan Dhan Yojana, etc., targeted delivery of government benefits. All those things happened. But post-2016, partially due to the effects of demonetization and partially due to the rebound in oil price and partially due to the consequences of lending that was made post-2008 and also subsequently, the non-performing loans issue began to dominate the headlines, and that has capped economic growth, and now that has spilled over into the non-banking financial world as well. So in a way, the recurrent cycles of rising current account deficits, rising non-performing loans, actually do send us a very clear reminder that we have not yet ensured a self-sustaining cycle of prosperity in this country. We have to face it. Our maximum growth, the speed limit at this point in time seems to be less than 7% and not above that. Only by accepting this reality, we can then decide what we need to do to make it a sustainable annual growth rate of 7 or even 8%. We need to first accept that reality that we may be temporarily, for statistical reasons, the fastest growing economy in the world, large economy in the world, but we are not a sustainably fast growing economy yet. Why is it that? That's because we have not invested or thought adequately about productivity. Whenever we mention productivity, we always think of infrastructure. We don't have ports, roads, airports, connectivity, etc., which hold down our productive potential. That is definitely true, but that is getting addressed. That is getting addressed in many parts of the country. You see metro stations, new rail, roads, highways, etc. Energy capacity is increased, etc. But our productivity problems also arise from our attitude towards work and also the amount of time we spend in terms of scoring political points rather than working on productivity. In my last column in Mint, I wrote that India may have a twin deficit problem in economics, fiscal deficit and current account deficit. But India has a twin surplus problem, which impinges on productivity. And that twin surplus problem is the problem of big egos and small minds. And that is a very big deterrent to productivity. In organizations, whether it is social, non-profit, for-profit, etc., that is a hurdle on productivity and therefore on prosperity. So we are a productivity challenged, an attitude challenged nation, and therefore we haven't yet locked in prosperity, and we need to work on that. And that is why we frequently run into crisis of finance, crisis of current account deficit and inflation, and that pull us back. After achieving 2-3 years of 7 plus growth, we again get pegged back to 5 and 6%. So we need to face that. The second aspect is inclusive growth. Yes, actually, we have taken some very important measures in the recent years. And as I mentioned, one of them is the Prime Minister's Jan Dhan Yojana. And financial inclusion is now really happening through this initiative. It is not just a question of opening bank accounts. We have academic studies corroborating the fact that these accounts are being used for transactions and they are not simply empty, idle accounts. That's a good thing. That is for individuals. But what about small businesses? Access to credit remains a big barrier for medium and small businesses. And it is not just coming from banks. It is not that the banks alone are responsible for denying access to credit. The bigger problem than bank finance access is the problem of working capital for small and medium businesses. And that comes because big businesses don't pay on time for supplies received from small manufacturers. And that is why a very micro initiative, you might think it's a matter of detail, but the devil is in the detail, or the angel is in the detail, which is that the Receivables Corporation of India Limited, which the Government of India set up after 7 years of deliberations, is a very important step. It is about factoring the receivables so that companies can discount the bills that they're supposed to receive from big buyers, and the banks will pay them in advance, and the banks will then collect the receivables from the big companies so that the working capital needs of small businesses do not get affected because big businesses don't pay them on time. And that is a very important initiative, but unfortunately, the private corporate sector is actually stalling this initiative. Most of us who think the problem in India is the government and the bureaucracy must rethink. India's private sector is as much part of the growth and prosperity problem as the government, if not more. And that is what we are witnessing with this crisis in the banking, bad debts, assets, etc. It is the private sector problem which the banks are facing. So inclusion means access to credit, access to working capital for small and medium businesses. Second is the farm sector, because still roughly 50% of the economy lives in rural India. And when you say farm sector, the only thing we are hearing about and reading about are loan waivers, which we know are not permanent solutions, but they have become permanent policy initiatives no matter which party is in office, in the state or at the union government level. But the real issues are in terms of irrigation facilities, access to irrigated arable land, and more importantly, absence of restrictions on how much farmers can sell, to whom, and at what prices. If that empowerment of farmers happens, because we have minimum export prices determined by Government of India when it should be determined by the market. But we are actually thwarting the farmers' ability to take advantage of global prices. So therefore, you cannot have an inclusive prosperity or economic growth with restrictions on the farm sector, on what farmers can do. Empowering farmers means empowering them to sell quantities at the price that the market will allow them. Then we can talk about inclusive prosperity. And lastly, in order to talk of inclusive prosperity, we need to rely on the benefits of facilitating economic activity and not on economic policing. In the last couple of days, we have seen some statistics which are very heartening on the direct taxes collection in the last 2 years. Partially, it is a success story of greater surveillance, collection efforts, etc. But partially, it is also a reflection on an extortionary tax department as well. Both are true. So we need to remember that we need to go back to the idea that government should primarily be a facilitator and not a policeman when it comes to economic activity. If these broad principles are kept in mind, we can not only achieve prosperity, but it will also be inclusive prosperity. Thank you, ladies and gentlemen.